Hello class, welcome to our discussion of C corporations. We've now switched from individual taxation to business taxation for the last 3 chapters of our textbook and the last couple weeks of our class. So business entities that we might consider C corporations. This is what we're going to talk about in Chapter 14, Partnerships, Limited Liability Partnerships. From a standpoint of federal income taxation, all three are the same. So they're all treated the same. And then S corporations are another entity that look an awful lot like partnerships as well. C corporations, Chapter 14. All of the partnership entity types are in Chapter 15. S corporations, our last chapter, chapter 16. So we had situations where C corporations are taxed separately from the owners. Now we can basically choose how we want it to be taxed. It doesn't, you don't have to wait to see what kinds of characteristics a entity has. So there's the ability to kind of choose what we call the check-the-box rules or check-the-box regulations. All right, if you are a C corporation, that means you have incorporated under state law, you have not elected a special treatment to make you an S corporation, then you become by default a C corporation. C corporation, the term C refers to the actual part of the tax code where the regulation or the rules are with regard to these types of corporations. All right. So they can choose accrual method, the cash method, or we have what's called the hybrid method, which is used an awful lot from the sale of inventory, and then for other income and deductions, treat it like a cash method that kind of gives you the, you may say, the best of both worlds, and probably is the most likely to reflect the actual income that you have as a corporation. So what does the corporate taxable income formula look like? Remember, we had one for individuals, we had worried about AGI, we had itemized deductions, all those things, we had credits. Much of that is no longer applicable. Gross income from our business. And then we have deductions, regular deductions, the ones we think about when it comes to a business. And then we have the special, the charitable contributions, the dividend received deductions, and short-term capital loss carrybacks. Those are what we refer to as special deductions. Those are unique to C corporations. They don't apply to other business entities. The regular deductions do. They would apply to whatever entity you were. And then you get taxable income, and then C corporations actually calculate their tax and pay their tax individually as a corporation. Now, one of the things that sets corporations apart, we learned that capital gains and losses back in Chapter 10 are special. Have a different tax rate. That does not apply to corporations. Capital gains are just like any other income, and capital losses only can offset capital gains. So remember, individuals can deduct up to $3,000 and so forth if they're and there's some special stock that allows for a higher deductions. That is not the case for corporations. C corporations can only use capital losses to offset capital gains. All right. They can go back and then forward, back 3 years and then forward 5 years. So kind of a consolation prize. You can't use it in the current year, but you could go back, and if you had capital gains, this rule still apply. You carry it back to find capital gains. Not that in those past years you can use it to offset regular income, but only capital gains. And everything that's carried forward is a short term. So carries back the excess, a short-term capital loss. Doesn't make that much difference because you have the regular income rates no matter what. So as far as short-term versus long-term for a corporation. All right, the next thing that kind of comes up is organizational costs. This is the things that you do to organize into a corporation, lawyer fees and things that you need to do, filing fees with the state to become a corporation. You can deduct up to $5,000 in the year you start beginning, because the assumption is that this is a asset and therefore would need to be amortized over time. This is saying that we can deduct up to $5,000 of those organizational costs, which would cover most simple corporations. And then that amount is reduced if you get too many organizational costs when they get over $50,000. All right. If you don't expense it now, you get to take it over 15 years or 180 months. That's just a long time to deduct that over that period of time. So, example, if you pay $40,000, begins on November 1st. They're not over 50, so we can deduct $5,000 in 2018, and then you amortize the rest, the 35, over 180 months, and there'll be 2 months, November, December, for 2018. So it's a straight line depreciation scenario. 54,000. This time we're over the 50,000, so we can only deduct $1,000 because the amount over 50 reduces how much we can deduct immediately, and then we take the rest of the 53 over 180 months. So 11 months in 2018 in this scenario, February through December. Startup costs are deductions that would be deductible if they were happened, but the business hasn't started yet. Investigating a new business is perhaps the most obvious one, or the most clearly one. Usually you can start the business quickly enough that you don't need too much in the way of startup costs. But in the case, you'll see that the rules are very similar to our organizational costs. $5,000 reduced for amounts over 50, okay? And then anything that you don't deduct immediately, you get to deduct over 15 years or 180 months. So 51, reduce it to $4,000 in 2018 and amortize the rest, $47,000 over 180 months for 7 months during 2018. All right, next special deduction, you might say, or the first special deduction. The organizational costs, the startup costs, are not necessarily special to C corporations. However, they probably come up more often in C corporations than they do on the other entities. But they apply, the same rules apply to all business entities. Charitable contribution, though, is only for C corporation. C corporations are limited to 10% of their income before certain deductions in terms of charitable. So it doesn't matter how much they pay in charitable contributions, they can only deduct 10%. Which means if they have a year where they lose money, there is no deduction for charitable contributions. Okay? They can be carried over for, but only 5 years, where they will also be subject. So even carrying it to the next year doesn't help unless you have income, and it's still limited to the 10% of the income of the new year. This is similar to individuals in that there is a limit that's just much lower. There's a limit to AGI, what you can deduct for charitable contributions. This one is much lower than your AGI limitations. And the 5-year carry forward is also for individuals, but here as well. $30,000 has taxable income of $200,000. They can only deduct $20,000. The other 10 carries forward and can be looked at again next year, and the next year up to 5 years. Dividends received deduction. This is perhaps the most confusing of the special deductions. Basically, the idea is if you're a C corporation and you receive dividends from another C corporation, then in theory you would actually have what's called triple taxation, because the first corporation paid tax on its earnings, the second then distributed earnings to the second corporation, which also paid tax on its earnings, and it distributes it to another, and they keep paying on that because dividends are not deductible for tax purposes. So paying dividends doesn't reduce your tax. So both sides are paying tax on the dividends. So if a corporation receives a dividend from another corporation, then you have this dividends received deduction. Now, when calculating your taxable income as a corporation, you must include the dividends received as revenue or part of the income. This is the deduction to offset some of what you record as income. So if you own less than 20% of another corporation, they pay you $100 in dividends. That's $100 of revenue. That then you get a deduction of 50% of that. So you end up paying tax on half, not the whole thing. Now, as you own more and more of the corporation, your percentage that you get to deduct goes up to the point where if you're over 80%, you add the dividends in, but then you get a deduction for the whole amount. So it's as if you didn't receive them at all. But only if you're over 80%. Anything less than that is going to be, there's going to be some part of it included in your taxes. So 15%, receive a $100,000 dividend. Looking on our chart, that is a 50% range. Okay, so they would record and have $100,000 of revenue added to whatever other revenue they have. Then when they take their deductions, one of the deductions they'll be able to take is half of the dividends received, $50,000. Now, when the ownership is less than 80%, remember this only applies for the less than 80% because over 80% it's 100% dividend received deduction. If you still have taxable income after using the DRD, okay, doing the regular standard percentage times the dividends received, the taxable income limit comes into play. So now you may have a DRD which is less than the standard dividend percentage. If the taxable income before the DRD is ends at, you multiply that percentage by that taxable income and it's lower, so you're taking the lesser of these two numbers. So example, 65% of a Killian corporation receives $10,000 dividends. Symbol's taxable income before DRD is $5,000. Standard percentage would be 10,000 times 65%. Using this DRD results in a $1,500 loss. If it results in a loss, you do not have to look at the other method of calculating it. You just are finished. The dividends received deduction is the set $6,500. However, if there is still income, then you must look at it the second way. China owns 20%, receive $40,000. Their income before the DRD is $35,000. They do the standard percentage. They get 26. This results in taxable income of $9,000. So it did not result in a loss. So we have to go to the next step. We have to take our income before the DRD, the $35,000, and multiply that by the 65%. Well, in this case, that's only 22 instead of 26. So you use the lower. So our DRD is only $22,750 because of the taxable income limitation in this scenario. All right, we're going to stop there and come back and pick up with net operating losses as we go to part 2 of corporations for chapter 14.